So welcome to this short commentary and summary of our investment performance on our model portfolios. This is for data to the 31st of March 2018, and it's part of a regular series where we provide information and data on how our model investment portfolios have performed. So before we start, I just want to take you through how we use model investment portfolios at Woodruff Financial Planning. It's part of our Prosper service, and it's a key part of the investment management service that we offer. And basically we have a series of risk-based investments for new investments. So if you become a client with us, we'll assess the level of risk that you want to take, the level of risk you need to take, and we'll place you in an investment portfolio that matches the risk that you want to take, and also goals such as whether you need capital growth or income. So of course that becomes very individualized with specific issues that are raised in the meetings, but this is the starting point for investments. So actual clients end up having a different investment to this over time, because what we do is we use this to review where your investments, how your investments have performed at annual reviews. And so we compare your actual investments versus the model, and then we're basically comparing sector by sector with an idea to show you whether your particular investments are doing and how they're doing against the ideal and the model. And one thing I should say is that none of this information gives you any kind of guarantees. So, obviously the actual performance of the investments that you make depends on a variety of different information. So really a variety of different circumstances. Really this information on the model portfolios is just designed to give you a flavour of how our different risk strategies have achieved using the strategies that we follow, and how they've done over the last 5 years or so. So bear in mind that the actual performance of your investments, should you make any, will be based on your personal circumstances, the timing of those investments, your personal tax position and the tax position of the investment wrapper that you're placed into, and the charges of your individual investments. So this is really just a broad strokes sort of run through of how our model portfolios work. So here's the data, and it's the data that is on the website as well. So let's just take you through. So basically what we have here is broken down into 1 year, 3 years and 5 years. So just a straightforward way to measure how the model portfolios have done over those periods here. And then we show an annualized return. So that's how over 1 year, obviously that's the 1 year return for that portfolio, but for a 3 and a 5 year portfolio, that's the average return to get to the cumulative return. So the cautious portfolio has generated 14.8% over 3 years. So had you invested 3 years ago, your money would have grown by that amount after 3 years, and the average return to get to 14.8% would be 4.71%. So we're looking at 5 years gives you a good flavour for the expected returns of those investments. And then we've broken it down into 5 separate areas. These are the growth portfolios, 5 separate risk strategies ranging from cautious to adventurous. So one thing I should say is that we've just come out of what I would categorise as a stock market wobble, which happened sort of February or so 2018, and so this data has changed quite significantly since the last time we ran it, which was 3 months ago. So the data we were shown at that point was looking significantly better, and that's for 2 reasons. That's because the stock market has dropped somewhat since the start of the year, and also we've lost the 3 months worth of data from 5 years ago. So if you look at the annualized 5 year data this quarter compared to the previous quarter, you will see a significant change. But that's what happens with these statistics, and this is why we produce these on a regular basis, with an eye to showing you how returns can change over time. And actually I would argue that these are perhaps slightly more realistic returns based on our expected returns that we'd expect for these portfolios anyway. So if you look at the cautious portfolio, we've broken it down into those 5 areas, and you can follow the line across for each separate portfolio, from moderately cautious to moderately adventurous and adventurous. And looking at the 5-year returns, it gives you a good flavour as to the kind of expected returns that you might have got based on the past performance. And bear in mind, again, this is before charges, and it's in no way guaranteed. So, but it gives you an idea of how taking more risk with investments can lead to greater returns over time. Although, of course, the reverse can also be true. But this is what we would normally expect at this kind of spread of improvements in returns based on the risk taken. But of course, at different stages of the cycle, you may see different results. The final thing to sort of point out is we've used Financial Express's risk score in this table. And so Financial Express is our data provider, and what they do is they provide a simple score for the UK stock market in the form of the FTSE 100. So that's the top 100 companies in the UK, and they rate those companies, or the amalgamation of those companies, as 100 on this scale over a 3-year period. So you can see a relative risk score based on that scale for the various portfolios that we currently offer, and this score does fluctuate over time as well as as things change in the portfolios. But it does give you a flavour to show that the cautious portfolio is just over a third of the risk of the stock market based on this scale, whereas the adventurous portfolio would be 8 out of 10 if you're looking at it that way. It's one measurement of risk, it's not the only measurement of risk, of course. So put all that together, and there's further information below this video on the website as to how we make these calculations. But had you invested £300,000 5 years ago in the 3 different strategies that we're showing here, that's what your return would have been after some sample investment charges and our financial advice charges. So it just gives you a flavour as to how someone could have done had they been in the model portfolio and invested exactly 5 years ago from the start of this data. Bear in mind what I said before about how this information is not guaranteed, and how it does vary based on your individual situation. We're just trying to give you a flavour as to the possibilities for investing your money after a period of time. Okay, so just to reiterate, it's the past performance of the actual models. It's not guaranteed because, of course, the past has gone and your situation will be different. But we have made some assumptions for product and advice charges in that information. And again, that is explained in a bit more detail on the website.